Now, inflation can be avoided if the amount of money that goes into the economy is regulated in a way that it doesn't exceed the actual activity that's happening in the economy. Now, the best way to do that, in my opinion, is to make sure that money is issued into the economy only for productive investment, for productive goods and services. So money goes in to help a small business start up, which creates jobs, which creates additional purchasing power, which means there's no inflation.
During their history, almost all central banks have employed forms of direct credit regulation. The central bank would determine desired nominal GDP growth, then calculate the necessary amount of credit creation to achieve this, and then allocate this credit creation both across the various banks and type of banks and across industrial sectors. Unproductive credit was suppressed. Thus, it was difficult or impossible to obtain bank credit for large-scale, purely speculative transactions, such as today's large-scale bank funding to hedge funds. The World Bank recognised in a 1993 study that this mechanism of intervention in credit allocation was at the core of the East Asian economic miracle.
There's all sorts of things that governments have done in the past, very successfully in a number of cases, and often not unsuccessfully in this country, but the examples that spring to mind, like South Korea, Japan, often in East Asia, where governments have been quite targeted about how they're going to rebalance the economy and picking sectors and deciding where the investment should take place. I think that has to start happening in the UK because we're in a demand-side recession rather than looking at a crisis of supply.
You have to have a system where credit is put into productive avenues, where credit is put into building high-speed rail links, where credit is put into building houses rather than giving people money to inflate the price of houses. So it's quite simple, really, in that way. The current system is simply set up not to do that, basically.
The creation of money by private banks for non-productive usage causes real inflation, and as such it is a tax on the purchasing power of the medium of exchange.
The figures for the UK are quite stark, actually, that average, median, real incomes so that's what the bit in the middle, for most people declined over the last 8 years or so. They're now in quite sharp decline as we go into the recession. I mean, the sharpest really since about the 1930s, put it that way. So real incomes are declining.
Bank-created fiat currency allows the private banks to suck wealth from the economy, and over time results in a gradual decrease in the standard of living. As people become poorer, they become even more dependent on debt. And this at a time when efficiency and machination have improved dramatically.
You go back to the 1960s, and we were expected we were looking forward to an age of leisure. They were talking television programmes saying, what's people going to do with all their spare time? And now we've got more people working harder than ever, spending more than ever, which looks great. Everyone's spending more. Everyone says, oh yeah, But if you're not actually benefiting from what you're spending, if you're having to spend the money on childcare costs, on commuting costs, and so forth, the costs that people didn't in the past used to have to pay, because you could walk to work, and one member of the family was able to stay at home and be a permanent homemaker, then you're not actually any better off. Everyone's under such enormous pressures nowadays. I am conscious that, my 4 nephews and nieces are facing difficult times. Just going to find themselves having to work, very hard just to keep a roof over them, just to get a roof over them, just to keep a roof over their head.
People are getting poorer in real terms. It's because prices are always going up, because all this new funny money is being pumped into the system by the banks, and they're creating it all as debt. So at the same time as prices are going up and things are getting more expensive, we're getting further and further into debt, and our wealth and the return that we get from actually working is getting less and less all the time. I mean, you can't deal with poverty when you have a financial system and a money system that distributes money from the poor to the very rich. Any distribution that you try and do in the opposite direction is, it's effectively pissing in the wind. If you look at issues like, increasing inequality, one obvious way to tackle inequality is to have, say, for example, a redistributive tax system. You tax the rich, you give some money to the poor, you move a bit of money down the scale. That's all very well, but if you completely overlook the fact that there's another redistributive system which is taking money from the poor and giving it to the rich, then you're not really going to tackle this inequality. And the way a debt-based money system works, it guarantees that for every pound of money, there's going to be a pound of debt. Now, that debt is typically going to end up with, the poor, the sort of lower middle classes. Those people end up with the debt, and they end up paying interest on that money, which then goes back to the banking sector and gets distributed to the people working in the city or in Wall Street. And what this system does overall is it distributes money from the poor to the rich, essentially. Distributes money from the poorer regions of the UK back to the City of London. And it also distributes money from all the small businesses, all the little factories around the UK, and distributes that money back into the financial sector.
We have a system whereby the activity of actually supplying our nation's money supply occurs under the very same roof as the same organisation that's responsible for profiting from putting together borrowers and lenders, i.e. a bank. So a bank creates our nation's money supply as well as making loans for profit.
The government cannot allow the banking system to fail, because if it did, over 97% of all money would disappear. This is why, in the event of a crisis, the risk is transferred to the taxpayer. But even during normal times, banks receive numerous guarantees and benefits beyond the right to create money.
Bill, by the way, I know the Bank of America is a very big bank. It happens I've got $32 there myself. Now, just between us, what assurance do I have that this money is safe?
Well, all deposits up to $10,000 are insured by the federal government in Washington.
That's my guarantee. Huh?
Yes.
Have you heard that the federal government is about $280 billion in the hole?
Banks receive large safety nets from the government. The taxpayer guarantees £85,000 as deposit insurance, and the Bank of England provides liquidity insurance in case a bank runs out of reserve currency.
Someone wrote that a big investment bank is like a giant vampire squid, wrapped around the face of humanity, hypnotizing politicians who throw money at the banks, no strings attached, no matter what damage is done, trashing the planet, forcing cuts to things that make life better. Goodbye schools, goodbye playgrounds, goodbye jobs. The bankers that we bailed out then gave themselves bonuses that were bigger than the first wave of public spending cuts. Britain alone gave the banks more money than it cost to put a man on the moon, 6 times over. Where did our money go? Who let the banks get away with it? Why? Can vampire squids ever be useful? No government yet is brave enough to tame them. Perhaps they need a plan.
The spending cuts agenda is an attempt by the government to shift debt from its account to that of the public. This is the government's response to the bank bailouts and is necessary in a debt-based monetary system where increased purchasing power is the result of growing debt and where a diversification of debt provides overall stability and market confidence. Policies such as student fee increases and the privatisation of public services, assets and industry follow the same model.
The problem we're facing, I think, is that there's this transference from the public debt to the private debt, which is essentially a way of transferring risk, actually, away from sort of UK PLC and the government onto the heads of individuals, and it's going to be the most vulnerable individuals who are going to have the most debt. Thus, it's a very unprogressive, regressive policy framework that the government's embarking on, where the risk is moved onto those who are most vulnerable. And if there is another financial shock, if there's an oil shock, for example, the people who will pay the penalty are the poorest people in society. Or homeowners, for example, who will fall into negative equity if interest rates go up even 1 or 2%, there'll be really big problems. So I don't think it's a sensible way forward at the moment at all, and it's regressive, and it's certainly not fair in the terms that the government's talking about, and it's certainly not a case of we're in this together.
As more of a country's resources and industries are privatised, the private sector takes on more debt. As a result, more money is created, and there is a boom. Some private equity companies have taken this theory to the extreme, engaging in a practice known as a leveraged buyout, where a company is purchased at an often inflated price, and the purchase price is transferred to the business as a debt. The company becomes responsible for the funding of its own purchase. These debts are often so great that the company needs to reduce staff, salaries, and research activities.
When you have to factor interest as a business, if you have to factor interest repayment into your goods and services, then you have to charge a perpetually higher price as you take on more and more debt.
An increase in the diversification of debt results in an increase in the money supply. When the money supply increases, more money is available for productive activities and consumption, which is the condition for a boom.
It's questionable whether we're going to get out of this recession or whether we'll just keep ticking along the way that we are now. However, if we do, then when we come out of this recession, when growth starts again, look at what happens to debt. It will rise, and it will keep rising. And the faster the economy is growing, the faster the debt will rise. And then give it another 3 to 5 years, we'll be back where we were. You know, the debt will become too much. People will start defaulting again. It's kind of the system that we're locked into now. Is we can't grow the economy without growing the debt, and the debt is the very thing that will bring down the economy. The only option going forwards is to reform it, to stop banks from creating money as debt. By fixing the monetary system, we can prevent the banks from ever causing another financial crisis. And we can also make the current public service cuts and the tax rises and the increase in national debt unnecessary.
The current monetary system allows the banking sector to extract wealth from the economy, whilst providing nothing productive in return.
I mean, why is it that we've got all this technology, all this new efficiency, and yet it now requires 2 people to finance a household, whereas in the 50s it only needed 1 person working? And the reason for that is not because these washing machines and everything are more expensive. It's because of all the debt, and it's because effectively the banking sector is creaming it off from everybody else. So a growing banking sector isn't a sign. It's not a good thing. If the banking sector is growing, it's either that it's becoming less efficient, or it's becoming a parasite on the rest of the economy. And that's, we can talk about the banking sector becoming 4%, 5%, 6% of GDP. What's happening to the rest of the economy? It's becoming 96, 95, 94% of GDP. We've got to get switched on to this now. If we want to have a chance of tackling any of the other big social issues, you've got to figure out the money issue.
The poorest in the world pay for crises, even when they've not benefited from the often reckless and speculative booms, like the housing boom in Ireland that preceded that crisis. Over the last 30 years, we've seen income differentials increase, so that the rich have got much, much richer, And ordinary people haven't. They've stayed the same, or they've got poorer. And one of the ways that the economy was kept going was by providing cheap credit, was by providing debt to those very people who couldn't really afford things anymore. So they kept buying. And when it collapses, it's those same people that have to pay once again, even though in many ways they were the victims the first time round.
As a result of the crises, the Bank of England has bought corporate debt and repackaged it at lower rates of interest. Yet the average person is being asked to pay more than ever to borrow on overdrafts and credit cards.
Debts between the very wealthy or between governments can always be renegotiated and always have been throughout world history. They're not anything set in stone. It's generally speaking when you have debts owed by the poor to the rich that suddenly debts become a sacred obligation, more important than anything else. The idea of renegotiating them becomes unthinkable.
Can you pin down exactly what would keep investors happy, make them feel more confident?
That's a tough one. Personally, it doesn't matter. I'm a trader. I don't really care about that kind of stuff.
Were you born in England?
If I see an opportunity to make money, I go with that. So, for most traders, we don't really care that much how they're going to fix the economy, how they're going to fix the whole situation. Our job is to make money from it. And personally, I've been dreaming of this moment for 3 years. If you know what to do, you can make a lot of money from this. I have a confession, which is I go to bed every night, I dream of another recession. I dream of another moment like this. I dream of another recession. I dream of another moment like this. You can make a lot of money from this.
Bruno, Virginia hurt somebody real bad. You ought to hate her. Incoming!
The way in which you can look across Europe now and see that the new Prime Minister of Greece, not elected, essentially imposed, Papademos, former employee of Goldman Sachs, the new Prime Minister and Finance Minister of Italy, Mario Monti, former employee of Goldman Sachs, the new President of the European Central Bank, former employee of Goldman Sachs. It's quite, you know, you kind of see these people popping up absolutely everywhere.
That's the way to change what we have. Take all power and all freedoms away from the people and collect everything into the hands of one small group with absolute power.
From the people, without the people, against the people.
What's been interesting out of all this, I suppose, is the question of democracy that's been opened up very starkly in Europe, that you have a government of bankers essentially imposed on you. It's bankers who more or less got us into this mess, to put it rather crudely, but that's a good first approximation to it. And then you say, OK, bankers are the people who are therefore going to get us out of it, and incidentally they're going to run your country now. There's a serious question of democracy that's opened up here.
By the way, the banking crisis drove more than 100 million people back into poverty. The mortality statistics of people who go into poverty rise hugely for a whole range of reasons. So the banking crisis isn't just about becoming poorer, it was about killing people as well. And guess what? We haven't really got to the bottom of it. We never held anybody to account. And we haven't done the radical reforming job that we really needed to do, because we mistakenly thought if we destabilise the position any further, it'll make matters worse. And guess who took the decisions? All the people who were there in the first place.
I think you ought to know that the business of one of these businessmen is murder.
Their weapons are modern, their thinking 2,000 years out of date.
Look, I was there when the Secretary and the Chairman of the Federal Reserve came those days and talked with members of Congress about what was going on. It was about September 15th. Here's the facts, and we don't even talk about these things. On Thursday at about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours the world economy would have collapsed.
When money is withdrawn internationally from one currency to another, the reserve currency shifts from the national bank of one country to the reserve account of the foreign bank. Foreign banks have relationships with local banks that allow them to hold foreign reserve currencies whilst not being a part of the central bank scheme at the local central bank. For example, when £1,000 is transferred into euros, a UK bank will agree an exchange rate with a euro area bank, perhaps 1.15 euros to the pound. The UK bank will then transfer £1,000 of the central reserve currency to the UK partner bank of the European bank, whilst the European bank will transfer 1,150 euros of reserve currency to the European partner bank of the UK bank.
What happens when currencies and the exchange rate system is no longer managed? What are some of the first consequences? Devaluations, speculation, imbalances, where some countries would accrue more and more and more. What? What would they accrue? Other currencies. Other currencies.
The reserve currency needs to be spent in the country of origin, or exchanged into other currencies. Most foreign banks do not have deposit-taking accounts outside of their national borders, and as such, the foreign reserves they hold do not come back to them in the form of deposits. When a country accumulates trade imbalances, it either accumulates foreign reserve currencies, in the case of surplus, or spends its own reserves, in the case of negative trade balances.
Balance of trade is basically the difference between what you're selling abroad and what you're buying from abroad. Now, the feature on the UK is that for a very long period of time it's had a deficit on something called the visible balance of trade, which is trade in things, well, things that you can see. So that is goods that you'd recognise, stuff you can put in containers, it's cars, computers, things that you'd see in a shop. That's been in substantial deficit for, I think it opened up it did open up in the early 1980s. And essentially it hasn't gone away since, and if anything has got wider and wider.
Foreign exchange reserves cannot be directly used for domestic spending. The money can only be spent abroad or on imports. A country with a large balance of trade deficit relies on its creditors to spend the imbalances accrued in its own market.
I mean, there have been proposals in the past to try and create a mechanism for those imbalances to match up. So Keynes, for instance, John Maynard Keynes, at the end of the Second World War, his original proposal for what became Bretton Woods and the set of institutions set up there, like the IMF and the World Bank, was that there would be a kind of international clearing union. This is particularly relating to the trade side rather than the sort of the financial side directly. But the principle was that, you know, once trade balances had opened up, everybody would bank through an international clearing bank, and that would kind of force everyone to eventually reconcile the imbalances that appeared in the real economy.
But no such mechanism exists. The accumulated net trade imbalance for the UK is around £800 billion.
In essence, what has happened is that over many years, some countries have had big trade surpluses and others big trade deficits. The countries with trade deficits have been spending more than they've been earning, so they've had to borrow from abroad. And they've been doing this year after year. Countries like that are the United States, ourselves, and some other countries in Europe. That cannot go on. And there are two ways in which this can come to an end. Either, and we're seeing this in some other countries in Europe, if they can't find new ways to become competitive, then their ability to repay the debts is called into question. Another way of doing it, which we followed, is that we got a credible plan to repay our debts, and the value of sterling has fallen by 25% to make our exports more competitive and attractive to overseas buyers, and it to be more attractive for British consumers to buy from British producers rather than overseas producers. That is what we have done to put in place a framework to rebalance our economy, and I'm sure that's the right way to do it.
Currency war, also known as competitive devaluation, is a condition where countries compete against each other to achieve a relatively low exchange rate for their currency. As the price to buy a particular currency falls, so too does the real price of exports from that country. Domestic industry receives a boost in demand, both at home and abroad.
It's made British exports appear rather cheaper, so they've kind of recovered a little bit, but because the rest of the world is now looking really quite ropey, they've started to fall back down again. So what we're looking at is something that almost a kind of anarchy, and in a way, the increasing anarchy. This is what's happened over the last few years, where the Brazilian finance minister has been most vocal about this, talking about currency wars, talking about the desire of national governments when confronted by a major recession. They think if we could export more, we could dig ourselves out of this recession. If we want to export more, we depreciate our currency. That makes our goods cheaper, everyone else buys them, we'll all be better off. Now, the issue here is that if you depreciate, it's like everybody else appreciates against you. Their stuff becomes more expensive, so they're not too happy about that. They also want to depreciate, and this is where you can see a competitive round of devaluations breaking out.
To decrease the value of its national currency, a national central bank sells reserve currency into the market. It creates this currency out of nothing by typing numbers into a computer. During the long phase of commodity money, the exchange rate would depend on the amount of gold, silver, or copper contained in the coins of each country. Similarly, after the advent of paper money and the gold standard, the exchange rate depended on the amount of gold a government promised to pay the holder of the banknotes. These amounts did not vary greatly in the short term, and as such, exchange rates between currencies were relatively stable. After the Second World War, currencies were pegged to the dollar, and the dollar was backed by gold. This system came to an end in 1971.
So, we have a modern financial system where money is now chaotically organized. There is no exchange rate because there's no gold standard system to sustain. So we don't need it. In fact, we believe the market will resolve all of the problems of exchange. Whether your currency should be worth more than mine is a reflection of your economy relative to mine. And if that changes, the currency and the exchange rate can change. And if we need that to happen, it'll happen magically by the efficiency of market and profit seeking, and you guys know the rest, I think.
A currency's value in relation to another currency is determined by the market. If more people want to buy a currency than sell it, its value increases. If more people want to sell, its value decreases. The value is set by individual banks. As they buy and sell currencies, they will adjust the exchange rate.
In the last study I read in 2007, each day on currency markets, $3.2 trillion are traded each day. Who knows what the global GDP is? 50. Again, Brucey, higher. 60, that's closer. The point is, think about that exchange happening every single day. There's about 260 business days a year. It takes a few weeks to match the global value of every economic transaction that happens everywhere, every day, in a year. And it takes a few weeks.
Obviously, all of us trade currency fairly regularly. If you go abroad, you exchange into another currency. That's a form of currency trading. You're swapping your pounds into whatever, euros or yen or whatever it might be. That happens fairly regularly, and that's a conventional part of the trading process. Now, large corporations have to do this on a regular basis. Where it becomes something that people question, and where you get people saying, well, hang on, this is speculation, is when you get people realising that currencies move around next to each other, and if they move around in value next to each other, there's always an opportunity to try and make money out of those changes in value, and therefore you can speculate on it. And that's the more sort of questionable end of the market. That's the bit of the market that things like a financial transactions tax would try and chop away at. Because the assumption there, and it's kind of not incorrect, is that this just produces instability for everyone else. That these people want volatility in the market because that's how they make their money. They want to encourage it, and they do encourage it by trading and speculating in the way that they do.
By 2010, the foreign exchange market had grown to be the largest and most liquid market in the world, with an average of $4 trillion of currency being exchanged every day.
Volatility creates a need. What does it do to countries, especially perhaps small ones like developing countries, if there are suddenly huge and instantly fluctuating financial flows? What do they have to do to cope?
Production of the products that they're selling on the
Increase their production and sell more, lowering the price, and becoming possibly even poorer.
Once you start talking about the international system, it becomes really quite a peculiar thing, in that a lot of it depends on simply sentiment and beliefs about what an economy is like, rather more than it depends on anything the economy might or might not actually be doing. And that can shift very, very rapidly, because if it's just somebody's belief about a currency is supportable, then they can carry on believing this until whenever. If that belief changes, it can change very rapidly in a financial market. The process of financial contagion can take place in just minutes, seconds even, that you can just move from being apparently quite a stable, robust economy to being one that suddenly sentiment has turned against you, and you find that markets are picking on you. And it can often be not much more than you're simply a next-door neighbour of a country that's currently in trouble.
Many of the world's financial crises in the past 30 years have been caused by rapid withdrawals of the nation's currency or the currencies of an entire region. This type of activity is often referred to as financial warfare.
It's benefited major institutions really quite substantially. Goldman Sachs, for example, or any large bank, has done somewhat better out of this set of arrangements than it would have done in a far more regulated environment. It's made people very, very wealthy. It's allowed financial markets to expand absolutely enormously. Anybody involved in that is keen on seeing a deregulated world. In the case of the UK, you have a government which has been quite overtly and deliberately and aggressively arguing against any forms of regulation being imposed on those financial markets. But it's not the case that someone's behind the scenes pulling the strings. It's that this is how the thing works quite deliberately, quite overtly in front of you. That's the world as it is. It's making some people very rich. They're quite happy with it.
I think it is a form of economic warfare. Much of the change in the way that the global economy works over the last 30 years result from this debt, this third world debt, because it's given rich countries and banks and the financial sector enormous amounts of power and control over the poorer bits of the world where a lot of the resources are that we like using. And that's been used in a way that many people have compared to a form of colonialism. I mean, it's a very real, direct form of power that's been used over those countries to force those countries to do what are really in the interests of the richest segments of the world that they do. And as a result of that, not only have corporations become absolutely, made huge amounts of profits and become absolutely enormous and all pervasive, but the financial sector has become even bigger than that. And the real money in the world to be made today is not by producing anything at all. It's simply by forms of speculating, basically making money from money. That's the most profitable and by far and away the biggest form of activity, of economic activity that exists in the world today.
To protect themselves, vulnerable countries need to accrue currency from rich countries who create these currencies out of nothing.
The Netherlands' first Governor General of Indonesia, the man who built the trade routes, fortified them. What I mean by that is built forts along them and fought Spanish fleets and British fleets, said about the development of the Netherlands Empire and Netherlands trade was, "We cannot make trade without war, nor war without trade." Money and power. So reserves have become the way in which you can insure yourself against what? Speculation. You said speculation. Speculative attack. Fall in the market. Bubbles.
When a country succumbs to a speculative attack, it is asked to deregulate its markets and conform its financial system to that of the dominant party.
The big problem that's faced by most developing countries who got into a debt crisis was that they were told by the powers that be in the world, the International Monetary Fund, which is in many ways governs the global financial system, that the way to get out of debt actually is first of all to restructure your economy, especially to increase your exports so you're earning more dollars, and then you can pay off your debt, which is normally in dollars or some other foreign currency. Unfortunately, time and time again that was proved to not be the case at all. Actually, countries cut back their public spending to the bone, so they stopped growing, they stopped having any potential for growth, and what they did produce was aimed at the export market, was aimed at creating dollars and so on. So they were paying off their debts, but they weren't developing their own economy at all. They were paying far, far, far more in debt repayments than they were spending on health or education or anything else, and their debts just kept getting bigger and bigger and bigger.
The country becomes a vassal state, allowing large corporations to exploit its natural resources and workforce.
It's not even shadowy. There's no great mystery about what's happening here and about the way the world operates. It's quite blunt. I mean, for the last 30 years, you've got something pretty much everywhere, well, it certainly spreads pretty much everywhere, that generally gets labelled neoliberalism, this idea that you should have floating exchange rates, weak regulation, particularly of financial markets, minimal government interference or involvement with what market does, and that's more or less how the world operates. And then there are institutions, and the outstanding one at this point is the IMF, that will actively try and enforce this state of affairs. So it's not greatly shadowy, if you see what I mean, that there are people behind the scenes somewhere trying to manipulate stuff. It's actually, this is quite overt. This is happening, and this is how, for my entire adult life, actually, is the way it starts to look like. This is how the world is operated, and it's made some people very, very wealthy. It's produced enormous concentrations of wealth.
So when the International Monetary Fund comes in order to try and alleviate a country's debt problems, it imposes a set of conditions. And in the 1980s and 90s, they called that set of conditions structural adjustment program. And it tends to take very similar forms wherever it happens. And indeed, we can see structural adjustment programs, in essence, happening today in countries like Greece and Portugal and Ireland, where countries are instructed to decrease the amount that they spend on the public sector. They are instructed to liberalise their trade market and liberalise their capital market, so money can much more easily come in and out of their economy. And the idea is that this will encourage investment to come in from richer parts of the world, and that all of their problems will be solved from this investment. And in actual fact, this has proved time and time again to be completely without foundation. In actual fact, what happens is it destroys fledgling industries and capacities in these developing countries, and developing countries become completely dependent on goods and services from developed countries and also from capital from developed countries. One of the things the International Monetary Fund is very keen on is telling countries to lower the taxes that should be paid by multinational corporations when they come and operate in a country, because then you'll encourage more multinational corporations to come in. Of course, what it also means is the profits that are made by those multinational corporations leave the country just as quickly, and the country itself doesn't benefit. And today you have many developing countries which have got almost no tax base. They've not developed a tax base at all, and so they're even more dependent on international capital markets, on the money markets, on creating debt. And that's why you have so many countries in the world that have really been robbed of their sovereignty. It's very difficult to see how democratic societies can evolve or function when actually a government is more dependent on the diktats of the International Monetary Fund and the money markets than it is on their own people.
What we've seen since the 1970s is a dramatic increase in a series of phenomena that have had a stimulative effect on the changes in the financial system that have brought us to the gleaming, shining metal and steel business that's over there. In case you don't know, that's the City of London I'm pointing at.
To compensate for the lack of a defined, commodity-based value underlying currencies, financial institutions developed securitization as a means to manage risk.
You develop securitization as a means to try and stabilize the whole system. This is a set of financial processes and financial innovations that really accelerate from the 70s, 80s onwards.
You had a chaotic system that needed to manage risk, and you had to innovate. You needed derivatives, options, futures. You have new markets in volatility management tools. Who knows what the term hedging is? Spreading your risk, managing your risk, insuring against your risk, precisely.
Up until very recently, up until the 1960s, the Securities and Exchange Commission would be quite clear that derivatives that weren't based on real products, like agricultural products, so pork belly futures or whatever, would in fact be essentially kind of gambling, and therefore you weren't allowed to trade them. That changes in the 60s, and everybody can trade, currency futures, things that are not based on real products, being traded at some point in the future, but are based on movements of currency prices. Once you have the system of fixed exchange rates breaks down, obviously this thing accelerates enormously. So as you get the rollback of government regulation here, you get the market taking over with its own products here. And the theory is that the market's better at regulating itself, it's more stable than if you have the government interfering all the time. The efficient markets hypothesis, the idea that you set up a financial market, they're fast, everybody in them is well informed, they all keep a very careful eye on what everyone else is doing, it will therefore be very stable and it will reflect real changes in the economy. It's not going to be driven by panics and manias and speculative bubbles. None of this really going to happen. If there is movement up and down, it's because something real is happening and traders and investors in the financial market are responding to it. So that's the efficient markets hypothesis. The practice, and I think what you see in 2008 is the kind of end of that process. The appearance of a crisis so major, the belief that it will simply be self-stabilising and self-regulating really can't carry on. I mean, the practice carries on anyway, but you can't really argue in the same way that you used to, that it's good or it's necessary or this is okay for the world.
In the last decade, we had a new innovation, something called the credit default swap, a way of buying insurance against the company you've invested in going bust. And in 2002, they were worth in total less than $1 trillion. In 2007, they were worth $60 trillion. That's 5 years.
Everybody's suddenly sitting there and thinking, oh, these CDOs we've made don't in fact provide the kind of stability that we thought. The maths that's inside of them is complete nonsense, it turns out. There's far more risk attached to trying to securitise risk and securitise debt in the way that we have done this than we thought, and we think these things are now worthless. The attempt to get more and more complex ways of regulating and shaping a financial market and trying to make a quick buck out of it as well actually helped produce the opposite effect to what its kind of apologists said, which is that it led to a spectacular crash.
What we saw as a result of this very different situation was one phenomenon above all, one sector above all grew, and that was the financial sector.
While the financial sector benefits enormously from the current monetary system, the system is neither stable nor fair.
The assumption in what the Bank of England does right now is that the cash that we hold is backed up by government debt. The government can back up its promises by the fact that it can tax the public. So what they're implying is that cash is backed up by government debt when government debt is backed up by the ability of government to get cash from the public.
Time and time again over the last 30 years, we've seen private debts being transformed into public debts, and ultimately the price of that debt is paid by the public in the debtor country.
This is why spending cuts are necessary. The system is designed to make certain people very rich at the expense of a nation's citizens and taxpayers. The system lowers the standard of living of the majority and distributes this wealth among the privileged.
So what we're left with is a financial system since the early 70s that has no fixed exchange rates, that suddenly has increasingly open financial borders, that has central banks having to manage without having any control because there's nothing here where the gold used to be. Chaotically, they have to ease quantitatively. They have to lend as a lender of last resort.
Throughout history, monetary systems were designed to give the dominant international power an advantage, and this power is fiercely defended and expanded on.
And they flee in terror from an incredible bogeyman.
An American flag is burned at the height of the demonstration. Both President Johnson and Francisco Franco were vilified. A new low in public protest added strain on Spanish-American relations.
Order in the court! Order in the court!
I want Americans and all the world to know.
Come on, fire!
I want Americans and all the world to know. America has no regard for conventions of war or rules of morality.
Fire! Objection overruled.
What I would like to see is a new kind of currency that is backed by something that is scarce and that we really need and we really value, something like energy or renewable energy, for example. So a sort of kilowatt-hour backed currency would be very interesting to me. We need to start valuing the things that are most scarce and that we need to survive as a human race in the long run. And backing an international currency with something like that will generate enormous investment in, for example, renewable energy, if that's the primary international unit of account that's being used. Another option is a basket of currencies. So you mix up the value of different currencies to create a very solid currency that people have confidence in.
Perhaps even better would be a basket of commodities with which to back up international currencies.
Now, if it was possible, internationally, some way or another, to get all these competing and increasingly competing national economies together and say, we're all going to sit down and write out an agreement, somewhat like the Bretton Woods Agreement, which will allow for, unlike Bretton Woods, allow for some currencies to be pegged against different baskets of goods that are more appropriate to their national economies. You can sort of arrange this. If you could arrange that to happen, then that would be nice, and you can see how that would start to create a kind of order in the international macroeconomy, which is otherwise lacking. The real difficulty there is just political. It's like, who on earth is going to do this? Who is the force that's going to kind of make this thing happen?
Creating a monetary system which is both fair and stable is possible and can be achieved. What are international organisations for, if not for such a purpose?